Welcome back to the deep dive. If you've been trying to make sense of the crypto markets lately, well, clarity's been pretty hard to come by. That October rally we were all watching, it hit a wall pretty dramatically, left a lot of investors feeling whiplashed, asking questions, especially about some key altcoins.
And that's exactly what we're tackling today. We want to cut through some of that chaos for you. The big question really is how these three, huge but kind of separate forces are crashing together right now. We're talking about these new AI forecasting models, rising geopolitical tensions, and central bank policy. How is all that dictating volatility and what people expect? It's a really unique mix.
Yeah, it feels unprecedented. So our goal here is to give you a shortcut, sort of, to understanding this complex picture. We're going to unpack those sudden macro shock, dive into some, frankly, pretty wild price predictions AI is throwing out for XRP, BNB, Solana, and also look at why some seasoned traders actually see this current pullback less as panic and more like a pack, like a necessary cleansing phase. Okay, let's start with that sudden U-turn. October looked promising, then bang, a sharp sell-off. What exactly triggered that shift? What was the pin?
Well, the pin was definitely geopolitical. It hit global risk sentiment hard. It was Donald Trump's announcement or suggestion, really, of maybe 100% tariffs on Chinese imports. That news just instantly flipped the switch to risk off globally. We saw stocks sell off everywhere, money flying to safety. And for crypto, critically, sharp liquidations in the futures markets. Lots of leverage got wiped out. It just shows how fast macro stuff can override everything else short term. And, this volatility is tied directly to what the Federal Reserve does next. Traders are very cautious. Everyone's waiting for signals from the next FOMC meeting. That's the Federal Open Market Committee setting interest rates.
Right. So what's the Fed grappling with specifically, and why does that make crypto markets so nervous right now?
Well, it's the classic dilemma, isn't it? They're trying to keep inflation down, which usually means higher rates, but they also don't want to trigger a deep recession, which argues for easing up for assets like Bitcoin, altcoins, basically anything seen as risk on. The feeling is only a really clear, maybe even surprising signal that they're done hiking rates, maybe even hinting at cuts next year. Only that could really spark a major turnaround. That's the fuel everyone's hoping for maybe a Santa rally.
Okay, but while all that macro fear is swirling, you mentioned an interesting counter signal, something happening on chain.
Yeah, it's fascinating. While the short-term price is getting knocked around by tariffs and Fed talk, on-chain data shows long-term holders are actually buying. They're accumulating during this uncertainty. It suggests let's call them veteran players, see these dips not really as danger, but more as good opportunities to buy assets they believe in long-term. Prime accumulation zones.
Okay, let's shift gears then, because this next part feels like science fiction turning into reality. Artificial intelligence. We're talking big models like Perplexity AI, Claude AI. They're not just summarizing news anymore, they're actually modeling and predicting crypto prices.
Yeah, and what's really interesting is how they're shaping expectations. It's not just basic TA anymore. These AI platforms are crunching just massive amounts of diverse data. Think of VC funding flows, regulatory shifts, how different assets are moving relative to each other. Not just, Twitter sentiment. They build these complex AI-driven sentiment models. And that gives their forecast this powerful kind of new layer of credibility, or perceived credibility at least. And the projections they're making are, well, they're bold. Perplexity AI, for instance, is forecasting pretty major rebounds before year-end for XRP, Cardano, and BNB.
And then there's Claude AI. It came out with a prediction for XRP that just sounds huge. $6 to $10 by the end of the year. I mean, hang on. That's not just a rally. That's enormous. A $10 XRP puts its market cap up near Ethereum levels, right? How does anyone justify the sheer amount of money needed for that?
That's the multi-billion-dollar question, isn't it? And it forces you to scrutinize the fundamentals versus the narrative. Is this AI amplifying a potential reality or just creating hype? The argument from analysts who support that kind of target hinges on two main things: the regulatory clarity XRP now has, and potential institutional integration. The narrative is basically that the market cap needed for $6 or $10 only becomes possible if and when big institutional money that's currently sitting on the sidelines because of regulatory fear finally decides to pour in.
Okay, so since AI is making waves about XRP, let's unpack that one first. You mentioned the shift from courtroom to $10 dreams. What's the real-world basis for that optimism?
Fundamentally, it all stems from that Ripple versus SEC court decision. Getting that clarity wasn't just symbolic. It genuinely boosted investor confidence almost immediately. Combine that legal clarity with the ongoing partnerships Ripple is building for cross-border payments, actual usage, and you've got a growth story. And it's significant that XRP has actually outperformed both Bitcoin and Ethereum year to date. That's a strong signal that confidence is really returning.
So if the institutional money is the key ingredient for that massive price target, what are the technical charts showing? Do they support that kind of explosive move?
Well, the charts show a period of consolidation, which could be seen as building pressure. Technical analysts point to three distinct bull flag patterns on the longer-term charts. Now, a bull flag, for those less familiar, it looks like a flag on a pole, a sharp price rise, the pole, followed by a brief downward sloping channel, the flag. It often signals a pause before the trend continues upwards. So this pattern suggests a strong consolidation that could support those big targets, like $6 to $10, if that institutional wave materializes with real force. But the big if remains a sudden macro shock, like those tariff talks, which could invalidate the pattern immediately.
Okay, let's move over to BNB. This one started as just a token for the Binance exchange, but it seems to have grown way beyond that.
Oh, absolutely. It's a great example of evolution in crypto. BNB isn't just for getting discounts on trading fees anymore. It's now a key part of their ecosystem for NFTs, for DeFi decentralized finance, where the amount of money locked in its system, the TVL, is growing, and for various payment integrations. It has genuine utility now. But maybe the most important driver for its long-term value, and something you, the learner, should really grasp, is the token burn. It's deflationary by design. Binance regularly removes a significant chunk of BNB tokens from circulation forever. That creates scarcity. Over time, simple supply and demand suggests this should support the price, making the remaining tokens more valuable.
And technically, does the chart reflect that underlying strength?
Technically, yeah. BNB had a strong breakout recently. Then, like everything else, it pulled back during this latest correction. Actually, veteran traders often like to see that kind of pattern, a breakout, then a pullback that shakes out weaker hands. It sets up a cleaner base. So if market momentum turns positive again, BNB could be positioned for another leg up. Some analysts are looking towards potentially the $1,600 level.
All right, third one on our list, Solana. This one feels like it's capturing a lot of the institutional buzz lately, especially with all the ETF talk.
Solana's narrative is definitely focused on resilience and institutional appeal. Yes, we have to mention the past network outages. Those were serious learning experiences for their engineering. But the ecosystem has shown impressive strength bouncing back. Its DeFi activity, the TVL growth, is strong. And those persistent rumors about a potential spot Solana ETF just keep feeding that institutional narrative. Functionally, Solana is playing a big role in tokenizing real-world assets RWAs and in expanding the use of stablecoins. That's real utility beyond just trading. Now, looking at its chart status, it's also consolidating after a breakout. And importantly, its relative strength index, the RSI, is sitting around 40 right now.
Okay, for listeners maybe not glued to charts, what does an RSI around 40 actually mean? Why is that significant?
Sure. So the RSI basically measures how fast prices are moving up or down. A high reading, like 70 or above, usually means an asset is overbought, maybe due for a pullback. A low reading, like 30 or below, suggests oversold. 40 is interesting because it's kind of in the middle, but leaning towards the lower end. It suggests Solana has cooled off after its earlier run-up. It's not overheated right now. That implies there could be significant room for it to move higher. Towards those targets some analysts see, like $360 or even $500 before it hits major selling pressure again. It suggests potential fuel left in the tank.
Okay, wow. So let's try to tie this all together. We've got macro uncertainty, these wild AI predictions, specific fundamentals for each coin. What's the bottom line for an average investor watching all these crazy swings? Is it buy the dip or head for the hills?
Well, if you look at market psychology and what experienced traders are saying, the message is pretty consistent.
Yeah.
These sharp corrections, while painful maybe, are seen as necessary, healthy even. They call them cleansing phases. They basically flush out excessive leverage, get rid of some of the froth and purely speculative bets that build up during rallies. So yeah, for newer investors, it feels stressful, but it resets the market structure. It reinforces that long-term view that for assets you really believe in, these dips can actually be opportunities, discounts, essentially.
Right. And while we're doing all this serious analysis, we kind of have to acknowledge the other side of the coin. The meme coin phenomenon is still going strong, isn't it?
Exactly. You can't ignore it. The rise of things like Maxi just shows there's still a huge segment of the market driven by pure speculation, by dig-in culture, high-staking rewards, that kind of thing. Meme coins prove that irrationality or maybe anti-fundamentalism is always there. They can pump even when the macro picture looks terrible. But, and it's a big, but we always emphasize, the risk profile of jumping into a pre-sale hype coin is just worlds apart from investing based on the utility and tokenomics of something like XRP or BNB. So, to sum it up for you, the learner, The crypto market right now is this incredibly tangled web. You've got regulatory progress like with XRP meeting solid token economics like BNB's burn mechanism alongside growing institutional interests like the Solana ETF buzz. And all of that is getting slammed by big macro forces, tariffs, Fed decisions, and now complicated further by these new AI forecasts trying to predict it all. It's a lot.
That's a really good way to put it, a tangled web. But the core message from the data, from on-chain activity, and from that veteran trader sentiment seems pretty clear. Macro fear creates noise and volatility. But for those playing the long game, it often creates valuable moments to accumulate. And hey, before we wrap with our final thought, if you got value out of this deep dive today, if we helped untangle that web even a little bit, please do take a second to subscribe, maybe drop a comment, like the video. Engaging really does help the channel, helps us show up in the algorithm, and frankly, lets us keep making this kind of crypto content for you. We appreciate it. Okay, now for that final thought to leave you with. The growing role of AI, like Perplexity and Claude, in predicting market moves is undeniable now. It's happening. So this raises a really fundamental question for the future, doesn't it? As we move forward, will markets ultimately follow traditional economic fundamentals? Or will they be increasingly shaped, maybe even driven, by the narratives and the high conviction predictions these powerful AI models create and amplify? Could they become self-fulfilling? It's something to definitely think about as you watch the markets evolve.